Hey guys, welcome to an all new basic investment term video. Today we're going to be talking about the very much demanded video, the REIT, the Real Estate Investment Trust. Now this is just a brief overview, what is an REIT in a nutshell and how it can affect your investment portfolio. I will make more videos concerning REITs, going in a lot more depth concerning certain specific aspects of the REITs, but this is just an overview. First off, before I get into it, I would just like to say that I'm very sorry for the gap in the upload schedule, but that I am now back at it and coming at you with at least one new video every single week. So don't forget to subscribe, leave a comment, and leave a thumbs up, guys. So REITs, what are they? They're sort of like mutual funds, but specific for real estate investments. There are many kinds of REITs. Specifically, there are the equity kind, which are based on property investments, specifically on the property, so the asset and the value of the property itself. There's the mortgage REIT, which is focused more on the loan part of real estate investment, so focused on mortgage-backed issues or the loan itself. And there's a hybrid form of REITs, which is invested into both forms of REITs. Now, what makes an REIT an REIT? There are certain criteria it has to achieve in order to be called a real estate investment trust. These, just a few of these are, I'm not going to go into all of them, but the most important ones are that it needs to have at least 75% of its asset values coming from real estate. All right, so 75% or more of the assets coming from real estate. The other one is it needs to have at least 75% of its gross income coming from that real estate part of the investment trust. All right, so the assets must be worth at least 75% of the total investment trust, and the gross income coming into that trust must be at least 75% from the real estate part of the trust. The other thing is here that's very important to note, it needs to have a dividend payout ratio of at least 90%. Now this is quite important for us, guys, because if you remember correctly in the how to choose a dividend paying stocks correctly, I was saying try not to get a stock that pays a too high that gets a higher dividend ratio, because a dividend payout ratio is a measure of sustainability. But the REIT is very specific, and it's very important to note that it is an exclusion to this rule. Okay, so don't apply the criteria that I've taught you before to REITs. They are a separate form of investments that you can't judge them by the same with the same standards. Okay, so it's not because the dividend payout ratio is at 95 or 96% that you should stay away from that REIT. It's all the opposite, actually, because in order to be called an REIT, it needs to have that redistribution of monthly income to the shareholders. So they usually get money on a monthly basis because they are either, let's say, commercial or private real estate investments. So they get money from rents, and they need to distribute that money back to shareholders on a 90% or more basis. So that's very important. Now, what are the certain advantages that you can look into it when you want to invest into REITs? Well, first of all, you have that exposure to real estate, so that can diversify your portfolio. If you're not very invested, or if you're not very concentrated on real estate, so you can get that diversification, so added security. From that, you can focus on REITs that have a more commercial flavor, or you can focus on REITs that have a more private or individual flavor, if you will. The high dividend payout ratio comes with a translation of a high dividend yield. A lot of REITs have a very high dividend yield, either more than 6, 7, 8, even more than 10% sometimes. So they can be very attractive to dividend investors for two reasons. Because of one, they pay on a monthly basis. So if you're getting close to that retirement and you want a steady stream of income, REITs can be a very good way to provide you with that safe and stable income. Now, safe with a little asterisk next to it, but you get a steady stream of income on a monthly basis. So that can be very interesting. And the other one is, if you're young and you want to compound that interest and build that dividend portfolio, you can invest it into a registered account and have that dividend sheltered from income taxes, and just build on that dividend year after year. So you can get that compound with the dividend reinvestment programs that we've talked about in the earlier videos. So you can go check that out if you don't know what that is. So if you're getting close to retirement, you can have it into a non-registered account. You will be taxed every single month on that dividend income that you make, but it can be a source of steady income. And the opposite is, if you're young, you can focus it into registered accounts and have that income reinvested and have that compound year after year, and build it to a pretty significant dividend portfolio over the years. So in a nutshell, this is what a real estate investment trust is. I hope this clears some of the questions that you guys had. I hope this sheds a little bit of light onto REITs. Like I said, there will be more in-depth videos concerning certain specific aspects of the REITs. So I'm going to leave this here, guys. If you enjoyed this video, don't forget to leave a thumbs up, leave a comment down below, and don't forget to share this video. Don't forget to hit that subscribe button as well, guys. Cheers. You can expect a new video in about a week or less. Cheers, guys.